Hello guys. Well, I got a lot of requests asking about options and what they are and how can we understand them, and they told me that we have heard and we have read and we have seen videos about options and how it is so good when you want to don't pay too much in each trade. So in this video, and I will be doing more videos about options, I will try just to explain to you the basics. Okay, so let's go to explanation. Okay, now I just take an example of Twitter because it is a small stock. Okay, now when you see all these numbers, it's overwhelming, and a lot of people, when they see this, what we call option chain, so I will just make here option chain, they don't understand really what does it mean, all these numbers. Okay, in order to make it easy, let me begin with this. If you want to buy a stock like Twitter on Friday, it was $28.10. Okay, just we take this example. Now, so Twitter is $28.10. Let's say you on Friday, last Friday, okay, you want to buy Twitter at $28.10. Now, how much you spend if you want to buy it? To buy 100 shares. Most of the people, they buy 100 shares. Let's say it is $2,810. It means $2,810. Now, a lot of people, they say, what? Why should I pay $2,810 instead of paying only an option contract, which is, for example, this $350, which means you pay only $350. You say to yourself, why should I pay $2,810 while I can pay only $350 and get this contract, and I control the stock 100 shares? Okay, so this is a new way to do trading, and some people like options because they pay less. Now, how this work? There is what we call calls and puts. Now, call option contract, what does it mean? It means if you think that the stock will go up. Okay? Now, put, if you think that the stock will go down, you buy a put option contract. So, in order to make it easy, let's begin with a call. Now, before you buy an option chain or option call, what you should do, you should choose first, you should choose what is the strike. Now, you try to say, what is this strike and what relation has with the option contract call. Now, strike, it means from what is the price that you begin to buy Twitter. Now here, let's begin with an example. $25. $25, this is the strike. It means as if you buy it in the past at $25. Now, if you want to buy it at $25, the price, the strike price, you will be paying $350. Now, $350 you should pay for this? It is expensive because you are buying from the past. It means when the stock was 25, that's why you are paying $350. Let's say you have the idea, for example, to buy at 28, like for example near today. Today the price is $20.10. Now let's say you want just to buy from the strike of today, which is 28 or 28.10. Now you understand that you are paying how much? Only $1.41. So the strike, okay, the strike, $28, it means it's near as our price of today, which is $20.10. Now you are paying only $1.41, which means when you buy this contract, you pay only $141. So you ask yourself, oh, this is much cheaper. It's very good. I just put $141 and I control $2,810. Okay? So in order for you to choose between this strike and this strike, so how can you choose? So it is up to you what you want to buy. No one will tell you what to buy, but $141, what will happen to this $121 or $350? Let's say an example, okay? Let's say now the stock is $20.10. Let's say it goes to 35. Now, if it goes to 35, it means your call will be making money. Okay? And all these numbers that you see here, all these numbers for the ask, for example, all these numbers, they become bigger and bigger and bigger. Okay? That's why you can make money. Now, there is another thing you can do also. Let's say you want to buy a strike that it is in the future. It is, let's say an example, it is $30.50. $30.50, you are going to pay only, let's say here, 49 cents. So let's go and take this strike, okay, which is $30.50. Now you understand that $30, it is above the price of the stock. Now, since it is above the strike, it has no real value. It means what we call intrinsic value. It has nothing, no value at all. It is zero. So that's why you pay only for the time you stay, which is until April 18, which is 13 days from now, which is Friday. Okay? So I will continue to explain. Now, since the strike is $30.50, you pay, for example, only 50 cents. You pay only 50 cents, which is $50 to control this Twitter contract option. Now you ask yourself, this 350 is bigger than 141, and 141 is bigger than $50. But you can buy all these contracts if you want. Now, if the price is the same or under the call strike, this is called in the money. In the money, it means you are buying something that has intrinsic value. It means it has a value. That's why it is expensive. Now, if you buy, for example, at the same strike, the same price of the stock today, this is called at the money. At the money. At the money, it means you are in the middle. Okay? The strike and your price of the stock is the same. Now, if you are buying something that it is that the strike is above the price of Twitter, which is $28.10, and the price is $30.50. Now here you say out of the money, out the money. What does it mean? It means you are only buying this $50. When you pay this $50, you are paying for what we call time only. You are not paying for any value, because the stock has no your strike option has no value. But you are buying $50. You are buying time to stay 13 days from today, because April 18 we have 13 days. This is from Friday, 6 April 2018. So for you as a trader, you are interested to buy options. Now, if you think that, for example, Twitter will go to 30 or 32 or 34, you can, for example, buy the strike 28.50, 29, 29.50 or 30. It means you can buy whatever you want. If the price of Twitter goes to these prices, all these prices that you see here will become bigger and bigger, and they are making money. Okay? But the opposite happened. Let's say $28.10 for today, which is Friday, 6 April 2018. What if the stock, Twitter, is going down from 28, it's going down to 27, 25, 20. All this, what you see here, will be going down, and you are losing money. Okay? So for you as a trader, this has a relation to a risk. If you want to buy some value of the contract, you can buy at 25, 26, 27, and you understand that the strike is below the price of Twitter. It means as if you are buying in the past. This is what we call in the money. But for you, it doesn't mean nothing. If the stock doesn't go up, and if it goes down, you lose this 350. You'll be losing a lot of money of this. Now, what is the good thing about options? The good thing is whatever you buy is what you risk. Okay? This is the good thing in terms of risk. Let's say here you buy at 28. You think that the stock will go up on Monday or Tuesday or Friday next week. So this 141, it can go to $200 or $300 or $400. So you will be making money. Okay? Even if you buy at $50, the strike $30.50, which is the strike. Now this, it is in the future, because now Twitter is only at 28.10. Okay? And you are buying 30. It means after $30.50, this $50 will become more and more, maybe 100 or 200 or 300, depending on the stock where it goes up. So the direction is very, very important here in order to make money or lose money. Now, The only thing I'm telling you here is that if you want to buy options, calls, and you think that the stock will be going up, you can choose any one of these, okay? Understand this is out of the money. It means 29, 29.50, 30. It means it has no intrinsic value. It means the contract itself has no value. And if in these 13 days the stock will not go to these prices, for example, your money, like this 141, it becomes worthless, and you lose it all if it doesn't go like up and up and up. Even this 350, okay, it will be losing money if the stock doesn't move up. So all what you can do is try to begin with whatever price you like. If you like at the money, you buy on the same price as the strike is the same as the price of today. If you think a few days, 2 days or 3 days or 4 days, the stock will go up, you can make money. But understand, if the stock from 28 goes down to 27, 26, you will be losing all this 141. But let's say you are lucky and you buy $50, just $50, and you think that the stock will go to $30.50, and it goes more than this, 31, 32, 30. Understand that this $50 will become $100, $200, $300. So you will be making a lot of money, okay? It's just because the strike is far away, far away from the price of today. But you understand that the market can do whatever. Now, all this I'm explaining is about the call. Now, another example you can do is puts. Puts is the opposite. Instead of shorting the stock, okay, shorting the stock and have a problem with selling short and the other stuff, and you are scared to sell short stock because you will be paying a lot of money, you will be paying interest rate, and you will be paying interest rate, and you will buy back the shares, whatever the price is. Okay? Now, the puts is the opposite. If you think that Twitter from $28.10, this is the price now, instead of paying $2,810 to buy 100 shares, this is because a contract is 100 shares. In general, they count with one contract is 100 shares. Now, if you, for example, you think that the stock from $28, it will be going down, okay? You will be either, for example, if you take 28 strike, you will be paying, so let's say $120, okay? $120, this is at the money, okay? If you think that from $28, this is the strike is $28. It means if the stock goes down $28, you are paying 120. If the stock is going down, this you will be making money. If the stock is going down, this 120, it becomes 150, 200, 300, depending on the price. Now, if you want to buy the $30.50 strike, okay, so you will be paying $259. Now, why you are buying more? Because you took $30.50 strike. It means you are in the money. It means you are buying as if you are buying from the past when the stock was 30. That's why it is more expensive. And if you want, for example, so this is say in the money, here, this is in the money, This 28, you are at the money. And if you want out of the money, what does it mean out of the money? It means you're, for example, you say $25 is your strike. $25 is your strike. So how much you pay here at the last, for example, 0.28 or 0.30, it doesn't matter. So you are paying, let's say, 280. Oh no, it's you pay only $28 or $30. Okay, so you understand here that you are paying only little, $28. Okay, but this $28, and you control 100 shares of, you control $2,810 by just paying $28. But let's say the stock is going down. If it's going down from 28 right now to 25, you will see that this 28 becomes bigger and bigger and bigger, and then you can make money. Okay? So as you can see now, it's up to you what you want to do, what you want to buy. No one will tell you, and no one will teach you what to buy. All this depends on your risk and how you see. If you have strategy, okay, and you think that the call and the puts is just to bet on the future. If you think that the stock will go up, you buy calls. If you think that the stock will go down, you buy the puts option contract. It is so easy. Don't think that this is very, very difficult. Whenever you buy or you sell, it's very easy, so it's not a big deal. Okay, so guys, thank you very much for watching. I'm trying just to make it very, very simple, these things, because in the future I will make more videos explaining more things. But understand that if you want to go into options, you should study a lot of things. Just these things can affect the options, but the main thing, here is the deal. The market has always one direction. Understand that in options, in stocks, in forex, in futures. If you are with the direction of the stock, you will make money whatever you do. Either you do options, you do stocks, you do forex, you do futures. It's when you are with the movement of the stock, either few days or few weeks or whatever. There are some who, instead of buying the whole stock, what they do is just they buy option. And here is the good thing, that if you lose just this premium that you pay. So if you are comfortable with not paying too much, you can just go to options and put some money in some strikes that you like, and you see yourself. If in the future you try 1 month, 2 months, 6 months, okay, you try yourself and begin to do options. If you find it very interesting, and you begin to make money from it, and you have some strategy. That's it. Okay, but understand, this is what I tell always. If you have $10,000, you put it in an option, all your money in an option, calls, and there is bad thing, understand that this 10,000 will be wiped out. Okay, Wall Street guys, they are not playing making these options. Okay, so this is a product. They let you control the stock, and you are paying little money. But understand, if you are against the direction, your money is gone. So whenever you want to put money, understand this can be gone, because the risk is 100%. It's like stock. Like a stock, for example, you buy a stock, you risk 2%. For example, I will just show you an example, just to make sure you understand this. Okay. So here is just I give you the difference between, okay, a stock, for example. Let's say just an example. Okay, let's say the stock is $100, and here you buy stock. Okay, so you buy 100 shares, so it is $10,000 you pay. So here I'm just giving you an example. Okay, now let's say $10,000, you put 5% is your stop loss, just to make it clear. Okay, stop loss is 5%. So let's say the stock goes down, you are stopped out. Okay, so you lose $500, so your money will be $9,500. Just an example. Okay, now if you buy, for example, okay, if you buy, for example, $10,000, no, let's say you buy one contract. Let's say it is $2,000 contract. Let's say the stock has been going down. You can lose all this if you are doing, let's say you buy a call and the stock has been going down. Your risk here is 100% for this money that you put. Although you put $2,000, which is not $10,000, but understand always, try to compare the stock with what you lose. Okay? Try to compare. If you buy a stock, let's say you put stop loss at 5%. So your loss is $500 you lost, and then you exit the trade. Now, but here, if you buy a call and it is $2,000 from this stock, which is a call option, it could be $1,500, it could be $1,000, it could be $2,000. This is just an example. Understand that the risk is 100%. So always when you want to buy a call or a put, try to see the money that you put, what is the percentage in a stock. This is just a way to do business. It means to calculate. Don't give too much to the market, because whatever you give, if you be mistaken, you will be losing a lot of money. So understand that Wall Street, when they create these options, they put a lot of things against the trader. So it's not always in favor of the trader. Understand? Although they make it easy for people who have less money to buy big stocks, but understand that this has a price to pay. The price is the risk. Okay? So when you begin with calls and puts, okay, and you get an initiation, try always to begin with little money. Try to study this for 1 month, 2 months, 6 months. Try mini strikes. Let's say you take only one stock. Don't jump to mini stocks. Try to see a stock that it is small and has options chains, and then just try with out of the money, with the money, and in the money. Try just and see what is good for you. If you can come up with a small strategy about this, you can make a lot of money. Okay? Especially when you are out of the money. Out of the money, it means what you buy has no value. You buy only the time to stay. For example, you stay 1 month or 2 months or 6 months. But understand, if you are right in the direction, your contract will become big and big. You buy it with 100, it can go to 1,000 or 2,000. And this is why some professionals, they like options, because if they are right, they can make a lot of money. But understand, if they are right, if they are wrong, they can lose a lot of money. That's why we have risk. Okay? So for me, I have only one training, which is called the training level 14, which is how to trade call and put options. I put a lot of information about the geeks, about a lot of things that you should understand when you see an option. This gives you an advantage to understand how it works. Okay? Now, a lot of people, they think, someone just sent me an email before, and I will make this clear for you. Some people think, for example, if the stock goes $1, let's say the thing is, the contract is $20. Okay? Now, they think, for example, if the stock is going 101 because it was 100, they think that this one goes here and becomes 21. Okay? This is false, because how the contract moves, it's different from the stock move. This has some other calculations that it is so difficult to understand. How? But if you want to understand, you can just do something which is very good, which is just check the options, let's say on Friday. After a few days, have the same strikes and try to see how the stock moves and how the strike moves. I will just explain. Okay, so let's say, for example, the price you bought it today of Twitter, since we have given Twitter, okay, Twitter, $3.20. This is what you bought. If the strike is $25, this is the strike. What you should do, this is on Friday, 6 April. So I will give you a way, Friday, 6 April. Now, try just, for example, few days, whatever day you want, and see the same price of Twitter contract. Try to see what is the price here, and with the same strike always, try to see how it moves. Let's say the stock goes up, how much it moves here from 320 up, or if it goes down, how much it goes down, and then compare it with the price of $20, $28.10, and compare it with with the few days after compared with this. Okay, so all this is on Friday. Twitter was $28.10. You buy 3.20. It means you spend $320 for this call. Call, it means that the stock, you want the stock, you think that the stock will go up. Let's say if it goes up. Let's say the stock from 28.10, it goes to 30. Now, when you see that price, go here and check how much you make money. Since the stock is going up and you buy a call, it means you will be making money. Try to see here how much you make money. Okay, how much you make money, and try to see the percentage here, the percentage here, the percentage here, and the percentage here. So let's say here, 28.10 to 30, the stock has gone $1.90. Try to see if your price of the contract is becoming, let's say, 1.90. So it could be 0, 11, okay, and 3, 4, 5. So try to check if you get this money here and it becomes $5.10. Now, it will not go like this. That's why I will just ask you to do the calculations and just to see. Now, by this, you will understand how the contract is moving. But there are other ways to know approximately, but it's not exactly, since options calculations takes into account a lot of things. Okay, it takes account a lot of things that it is so complex. But in order to make it easy for you, just compare Twitter contract price call 3.20 on Friday. After a few days, go and check how much it is and see if the stock has been going up or going down, and see how much it will go up or go down. Okay, this is just a kind of practice for you guys, those who are interested in options. Maybe those who don't have money, they have only, let's say, $500, $1,000. They can't buy stocks, they can't buy anything, so you can just go and do some options. Okay, but understand that the risk is more, but you will be paying less money because you don't have money. Okay, so it is just to practice, because when you practice you see things. Don't just have theory. Theory is good, but it will not help you understand the price. Okay, so for those who are interested, you can check my training level 14, how to trade call and put options. There are a lot of information there, but for me, I'm trying to make it easy for you. And in following days or following weeks, I will be making more videos about options, because there are a lot of things you should understand before even you begin to trade. But if you want to trade, you want just to try, understand the good thing. Let's say if you put $50 in the contract, if you lose it, you lose only $50. This is the good thing about options. It's not like a stock. A stock, for example, you put $2,000 in a stock, let's say a penny stock, but if you leave it without stop loss, it can take all your money. Okay, if the stock can go down, it can take all your money. So in options, you understand how much you will be losing. This is the good thing in options, but the risk is more and more. Okay, so thank you very much for watching. Please share my videos and subscribe if you don't. If you have more questions, please ask. And in next videos, I'll be reading your comments and I will be doing more videos for you guys. Thank you very much.